Hello and welcome to FinTech Diary. The world of FinTech is evolving constantly, and we at FinTech Diary try to have these changes for you. My name is Amol Dete. You're watching EP15.com, and my guest for this particular chapter of FinTech Diary is Atul Shinghal, founder and CEO, Scripbox. Atul, glad to have you.
Good morning and good day to your audience. And it's my pleasure to be here, Amol.
So, Atul, I was going through your profile, and it's quite unusual, or must say, very uncommon. You were selling threads, then you worked in what you can say, the mutual fund companies, finance companies. You lived in an army family, that's very prestigious. Maybe traveled around the world. And I guess you made so much money, perhaps. That's why you want people to make money and you started Scriptbox. Is it something like that?
So while the first part is absolutely true that I've had a very privileged background as an army general's son and having traveled both while as a child and also in my career. And yeah, as my father, God bless his soul, used to say, "Ye dhaga bechta hai." So I mean, there's an episode. My elder brother, who's a current serving lieutenant general, he used to introduce my elder brother to all these generals that meet my elder son, this armored corps, etc. Or ye dhaga bechta hai. And I had all these IIT, IIM, Mayo degrees. Yeah, but to come back, the reason I started this because I didn't make money. I realized that the mistakes we made when we were younger, by not saving, not investing, not thinking about markets, shouldn't be repeated by the younger generation. So the idea behind Scriptbox was always how do we simplify the concept of wealth creation for everyone. Right. And we've stayed true to that so far. So to answer your question, no, I didn't make enough money. I wanted to make lots of money for all our customers. And hence we started Scriptbox.
Yeah, sure. So that's good to begin with, Atul. So tell me something about your experience in this particular segment, because a lot of fintechs that I am meeting are hardly 2 to 3 years old now. They're very aspirational, but you are quite mature compared to them. 10 to 11 years you are operations. How has the market changed? Did you reach to a destination or a level where you wanted to reach maybe the plan that you made 10 years back?
As always, Amol, your questions are complex and thoughtful. So I'll answer the second question first. This is a journey. I don't think there's a destination. We are way ahead in some matters. We are not where we wanted to be in some matters. In the matters where we're way ahead is the customer love we have generated, the number of families we serve. We're slightly behind where we would like to be in terms of sheer size and scale. We manage about $2 billion of assets under management. As a pure wealth manager, I'm not talking in the fintech space. We're probably in the top 7, 8 in the country, which gives us a lot of pride. But this is a low value business. We are profitable. So lots of markers we are very happy with. But yeah, as any ambitious entrepreneur would say, I'd love to be 2 times, 3 times the size. But the beauty of our business is because it's permanently compounding. We'll get there 2 years later, right? So that's one part where we wanted to be in terms of that. Yeah, we've been around for 10 years. So in the journey, we've learned a lot. We've learned that it takes longer than you plan for. It costs more. As I always joke, if you're if you're acquiring customers only online, like you joked about initially that if not us, at least the t-shirt companies have made money. Facebook and Google always make money. Because all of us are spending money on those channels to acquire our customers. So it takes much longer for digital companies to make money than you originally planned, right? Because it gets crowded, customer acquisition becomes more and more expensive. Very often, what we underestimate is the dollar-denominated cost of customer acquisition, right? So you will plan something in rupees and the dollar will move by 10%. And suddenly your CAC is up by 10%, right? And those, as you said, there are lots of new age fintech startups. VC money was easy to come by till 2, 3 years ago. And that's all gone into customer acquisition. And it just lifts the entire cost for everybody. So what happened in, say, 2017, 2018, when tech salaries went through the roof, especially in Bangalore, because there was so much funding around, the tech salaries went through the roof. The same thing happened in terms of customer CAC, right? There's just so much money being poured into the same customer set that it became more expensive. So that's my learning, that be patient, it takes time, always be focused on profitability, always be focused on the bottom line as much as the top line. And you'll build a business which is sustainable. It might not be the fastest growing, but it'll be sustainable.
Sure, I think that's a very good thought. In fact, Atul. Uh, I copy with you because I think around that 2017, 18, even a lot of people from different segments used to say, wish I could have been in IT, looking at the packages that the IT
Absolutely.
engineers were obtaining. Uh, so that was a story. But since you're profitable, I would like you to tell our readers, viewers, because they will be really happy to know because a lot of fintechs also watch this show. How long did it actually take for you to become profitable? Because there are companies which you own works for more than 10 years, in the market, but they still don't make money because maybe their projections are different. So is it that you decided when you launched a company that I want to be profitable first and maybe growth later? How did you, put your thoughts together and how did you become profitable?
So I would say we were always revenue focused to begin with, unlike a lot of other fintech players, even in our space, who were not even revenue focused. They were only growth focused. So we always had a revenue based model. We were very focused on unit economics. How much does it cost to serve a customer, and are we profitable at a customer service level? And we've always been from day one, right? Obviously, we spent a lot of money in building our platform, building our brand, acquiring customers. And I think it's hard coded in an Excel spreadsheet that you will break even in 7 years. And I think we stayed true to that. Somewhere along the journey, we started generating cash, and we plowed that cash back. We obviously raised more capital as part of our growth strategy to acquire like-minded businesses or partner with like-minded businesses, and that's cost us capital. But if you focus tightly enough on being revenue generating to begin with, being very clear on your revenue model. I mentor quite a few startups, and the first question I ask them is, who's going to pay you, and for what? I mean, what problem are you solving, or what value are you adding, so that they'll pay you for it. And once you're clear who's going to pay you and how much, and you figure out how much it's going to cost to serve them, and if the economics, uh, if you are clear and you're not doing contribution margin, EBITDA, and any of those complex math, and keeping it very, very simple, that is my operating cost lower than my the revenue I make, then you are in a good place. And I think that we have been for many years now.
So I think that's a great mantra, Atul. So how's the market now? When you started and when you're operating now, there is a big difference. A lot of new players have come. Few of them have also become unicorns, partnered with a lot of other players. Uh, and the mutual fund segment or AMC market or the investment market has also changed. I mean, it's heartening to see that we had hardly 3 to 4 crores of investors just 10 years back in the market, which reached almost 14 to 15 crore, in last 1 year, specifically if I'm talking about SIPs and the mutual funds. So how do you read the current trend specifically into investments?
So I'll answer the question in 3, 4 parts, Amol, if you'll allow me. One is from a customer perspective. Obviously, there's a much higher level of awareness. COVID was a watershed moment. There are a lot of people realized they have to be serious about their finances, started looking at that and investing in the markets. What also happened is that a lot more has happened in the trading part, right? So if you look at the FNO or daily trading, or even actually the number of demat accounts growth is far outpaced the number of mutual fund accounts, right? And I think some of those demat accounts are now starting to start small trading SIPs, and I really hope that that trading mentality is not what people are looking at, but wealth creation. So we've seen some difference in terms of over the last 3, 4 years, that there's more participation, but it's yet to translate into long-term wealth creation participation. People are still trying to make quick money, right? Whether it's in mutual funds, so you see websites which say most popular fund of the day, or they'll say things like most bought fund of the day, or last 7 days who did. That's not how wealth gets created. I mean, we keep saying that time in the market and not timing the market. We keep saying that. So mature investing or mature wealth creation is yet to happen, and I think it's the beginning. It'll happen. It's a good trend that people are participating. The other end of the spectrum is that the infrastructure available for people like us to provide services to our customers has completely evolved. When we started, we had to build the back end ourselves, the middleware, the front end, our pipes into the RTAs. All that is now available on the click of a button. So a lot more participants can offer services much more easily, which is a fantastic part. In terms of the middle, from the customer, from the product proposition, from the manufacturers, which is the mutual funds themselves, direct has obviously taken off, direct funds versus regular funds. I think a lot more narrative is there around that. And I'm confident that you can't really bring an e-commerce mindset to an area like wealth management. What do I mean by that? So an e-commerce mindset is cheaper, better, discounted. But this is wealth, right? It requires nurturing. It requires long term. You buying cheap doesn't make you make money. Staying the course makes you make money. Asset allocation makes you money. Uh, uh, Being in the market, investing regularly. So I think those habits are yet to evolve, right? I think those that's an area we feel a lot more customer education is required, a lot more time is required, where people go from trading, chasing returns, short term making money. But it'll come. At least there's participation now, and that participation will get into maturity, and that hopefully in the next 10 years we'll see a lot more wealth creation in India.
Hmm. Sure, very, very realistic thoughts, Atul. In fact, and on one side, it's nice to say a lot of people are, coming into the market. But like you said initially, that most of them are looking for quick money. In fact, I have been faced that question most of the times being a finance journalist. Earlier, I used to work with TV, and when I used to say somebody I'm working as a finance journalist, then the first question they will ask, "Acha, which stocks to buy? Give me some tips."
So imagine my situation as the CEO of a wealth management company. Whichever dinner you go to, acha, the guys, I'll lapse into Hindi. They'll hear the whole story. Acha, how much returns do you give? I said, I don't give returns. I give you wealth creation. But what is your average return? I said, I've got 100,000 families, right? Somebody wants to put their children in college. Somebody wants to go retire. Somebody wants to buy a car. I mean, they obviously have very different portfolios. So how do I answer a question? How much return does it give? But unfortunately, we are wired towards return. And I think this comes from a little bit of history, actually. The reason, I mean, everybody says, why are fixed deposits so popular, right? But if you look at history, fixed deposit is you give you 18% return in the 1980s, right? And then a 16% return in the 1990s. Then it came to 14. Now the fact that they give you 7%, people don't realize, right? So some of the older generation loves FDs because the returns were so extraordinary. Once you mentally benchmark yourselves to a 15% return, everything looks bad. Whereas we feel anything 4% over inflation, you're in a very good place.
Yeah. No, so noted your points. I think people should not look at the quick money and not chase multi-bagger all the time.
Yes.
You've said that line, mature wealth management yet to happen. So how's the trend shifting towards that? I think that's a very nice line that you said. Are people now out of whatever the people are coming to market? At least few of them are serious about thinking about future and not tomorrow, not about typical short term. Are you seeing that trend now, or everybody's just chasing the quick money?
So I think we're seeing both. I think we are seeing people. So we feel people at about age of 35, when they just got married or and have had their first child, is when they really realize that I have to create longer term wealth, right? So I think there's an age barrier, there is a timing barrier, and also I think the markets have run up so well in the last 1 year. So even if you were trading, you probably made money, right? So since we've not had uh, a bad one, I mean, and we know market cycles happen, so you have to just stay with the market cycle for a long time. So to answer your question, yes, we are seeing a little bit more movement towards people at least putting a portion of their wealth into long-term assets, keeping some, as we call, gambling money, or continuing to play. And we hope the trend will increase. But unfortunately, and I, with due respect, from a media perspective, there are so many more articles or so many more shows around multi-baggers, stock to buy, influencers, tips. So that's what the audience wants to hear, and that's what the media plays back. I hope and I wish there are more shows where I talk about how long it takes to create wealth, the power of compounding. Warren Buffett made 80% of his wealth in the last 4 years of his. Some of that, if you're just able to demonstrate that wealth just takes time to create you, and you really can't. There's no shortcut to success. The question you asked me, that Atul, you've been around for 10 years. We got to $2 billion because we were around for 10, 11 years, right? It takes time.
Absolutely. And that 10, 11 years in this company, before that also you worked. So that experience also counts and, matters while you speak about $2 billion. Noted your points. Tell me something about your product. How actually have you segregated your product? How do you actually sell your products? What kind of advices do you make? And where is the demand that is coming from? Because yes, people have taken some interest in SIPs, but you're looking at education, whole goal of the retirement, because pension is again under achiever in this country. And then the home loans or other family plannings. How do you actually have categorized the whole SIPs and the mutual fund ecosystem for you?
Fantastic, thank you. So we are what we call a digital wealth manager. And what does digital mean? Digital doesn't mean online. A lot of people get confused by online and digital. Online is just a channel. I mean, I now say this often that Amazon versus say a Big Bazaar online are very different businesses, right? So we are the Amazon equivalent. We are fully digital in the full stack. Automation, all our portfolio construction is completely mathematical. All our fund selection is completely mathematical. So the DNA is math and science and technology and automation. And how does this matter to our customers? So when we obviously, when the customer gets onboarded, we first understand their existing circumstances, right? What is their risk appetite? What is their risk capability, right? I might want to take a lot of risk, but I have very little money or I have a large family to support. So understand the customer, understand what they already have, because very likely they've bought a ULIP, they've bought a LIC policy, they've dabbled in a bit of stock, they've bought some SIP mutual funds. Create a view of where you are, where you want to go to, right? And that GPS, our role is that GPS. So we can only, the way we describe our role is we are your co-driver and your seat belt. So we'll prevent you having a crash and we'll sit next to you and tell you the way to go, right? We'll figure out where you are, we'll figure out where you want to go, and we'll show you the safest path to getting there. Now, what does that mean? So we'll create a portfolio for you, right? So we'll do asset allocation. We'll say, okay, your goal is 8 years away. We think you should be 60% in equity, 20% in fixed income, maybe 10% in gold, and maybe 10% in international equity. Why did we decide that? Because we've done 40 years of back testing around uncorrelated assets. How do they move? What kind of risk appetite should you do? So like we always say, 100% equity portfolio, mathematically you can prove is going to likely to give lower returns than an 80% equity-based portfolio, right? Because of the down cycles, etc. So using this science, we'll create a portfolio. Now, within the 60% of equity, you want to say, right? Now, should you put large cap, mid cap, small cap? What time? Because now mid caps and small caps have run up. Maybe there's more large cap required. Maybe 2 years from later, less large cap, more mid cap. This is all mathematical. Within large cap, there are 60 funds. Which 2 funds should go into your portfolio at this point in time? When should you rebalance? So this entire journey, right? Goal-based asset allocation, dynamically managed on an automated system. So all you need to think about is how much does it take to put my children through college? Leave the rest to us. Now, whether you do this online, digitally fully, whether you want one of our relationship managers to explain this to you, or you want one of our relationship managers to do it for you, all options exist for you. So we realize that India is not a DIY market. The thing I say, like people will buy furniture from IKEA and call a carpenter home, right? India is a do-it-for-me market. If you look at the success of Urban Clap or Urban Company, they need people to do their stuff for them. Similarly, our belief is in wealth, people need handholding. And whether you do the handholding through education on a platform, by creating these automated portfolios, you do it through a relationship manager, you do it in person, is the customer's choice. This is a psychographic requirement. So at Scripbox, we are able to offer all of these services profitably. And hence, we are able to serve customers from 50,000 rupees to 500 crores profitably, right? We're able to meet the customer service requirements, but provide this entire stack of wealth management. So if you're investing 1 lakh a month, you really don't need 20 funds. You don't need AIFs. You don't need startup investing. You're investing, you've given us 10 crores to manage. It's a very different portfolio.
Right.
Right. So the ability to match assets to customer needs in a dynamic manner, but in a evidence-based, unbiased, math-driven is Scriptbox's heart.
Fantastic. In fact, I really copied your point, DIY, do it yourself, not necessary, but do it on your own or do it for me. I think that's a very important point, because even I wrote about it very recently also, that IKEA or some related shops, people can't even do the basic assembling because we are never learned. And specifically in the finance, we need a support, we need an assistance. But Atul, my question to you now is, obviously I understood how you actually demonstrate your products and how the mathematics. Simple question that I have is, what makes you so confident to suggest XYZ product to ABC family? What kinds of data do you follow so that you are sure that that family who's coming to you perhaps will achieve its goal, whatever the stipulated time period that you're looking?
So I'm not sure at all. I mean, I'm no soothsayer, I'm no fortune teller, but I do believe my processes are time tested. Markets follow cycles. As long as you are doing the right thing and you're avoiding risk, right? One of our fundamental philosophies is I will not I'll try my best not to lose you money, right? So down days, high standard deviation, volatility are things we don't like. We try, so that's why I said we don't promise returns. We promise ease of that. So our brand credo is financial santushti. कि आप आराम से सोगे, you'll sleep easy at night. Now, I can't promise you anything, but I will try my level best that we are always there with you. We will do course corrections with you as we go along as your co-driver. So yeah, our endeavor is that our customers, we've got more than 10,000 customers who become rupee millionaires on the journey with us. And I think that's my biggest satisfaction. So what makes me proud is that people trusted us with their money and have grown their wealth to become, as they say, lakhpati or millionaires in rupee terms. I hope they'll become crorpatis in the next 5 years, just staying the journey. No guarantees, absolutely, but hand on the heart, use math. Unfortunately, because of my degrees and having spent 10 years at Capital One, in God we trust, the rest need to bring data. So all our models are time tested for at least the back 10 to 12 years now, 15 years. Our asset allocation models are 40-year tested. And there's a large team who are doing this on a daily basis, just testing models, making them better, weeding out bad. And I think in markets has taught us that the way to make money is not to lose money.
Exactly. No big dreams of, you will become multi-bagger. I will give you multi-bagger and highest returns. I think that's quite interesting. Noted your points, Atul. Maybe last one or two important points now in terms of what next. You're already there since last 10, 11 years. You're already in top 10. You're already a name in the industry, and you're, have a variety of products. What next? Are you going to raise more funds? Are you going to expand heavily? How do you see yourself maybe next 1 to 2 years? What are your plans now?
So there are obviously we are all ambitious we are big believers in the India story. McKinsey says the next century belongs to India. At least the next decade definitely belongs to India. So our vision when we set out to set up the company was to serve 1 million families to reach financial freedom. And it's not amount of money; it's a state of mind. We're at 100,000, so we are 1/10 there. But this is a compounding business. I'm pretty confident in the next 10 years we'll have 1 million families who say Scripbox was my partner in my wealth journey. In the next couple of years, we hope to continue to grow. We hope to find a few more partners who will join us and join our platform to serve more customers better. And more importantly, we want to make sure that our existing customers continue to trust us. We are an Axel funded company. Hopefully we're able to provide them a good exit, whether that, I'm not in a liberty to tell you what the exact specifics are, but we're working hard to make sure that people who trusted us as investors on our cap table, we justify their trust in us and they get a decent return.
Certainly. Now, quickly, let me shift your focus to the industry. A couple of more players have entered into this space. More are actually entering in this space, and suddenly the wealth management profile has become bigger with many players coming into it. So, one, how do you see this competition? And second, do you see a scope specifically for more wealth management players in this space?
Oh, absolutely. We would. I think the market is hugely underserved. At 15% of GDP, as the retail mutual fund industry is, I would say, amongst the lowest in the global averages. South Africa, Australia, UK are at 60, 70%. US is 110%. So the market can go 4, 5, 10x from here, and there'll still be headroom to grow. So I believe competition is great. It makes the product sharper. But as such, I think people use the word wealth tech very loosely. Most people are providing you investment solutions. Very few players are offering you wealth solutions. So you have alternative investments coming in. You have people doing stuff on peer-to-peer lending. You're doing stuff on alternative investments, supply chain finance, retailizing all that, or even gold. A large, very popular category is obviously stock broking or discount broking. But wealth creation, I think, unfortunately, we don't have any direct competition, which scares me. I think either we are doing something wrong because it's very hard work, or we are doing something right. So, but I believe in the next 5 to 7 years, of the many people who are coming in and trying, there will be more maturity, but there's enough headroom to play. I think we've all only just scratched the surface. I wish everybody who's entering provides great value to their customers over the next many years. But it's still evolving. I think people will burn their fingers, some of them, because it's a low margin business. It's a low revenue business, and it takes scale matters, right? In this, you really have to get to a certain size and scale to just be able to sustain.
Mm. Sure. And on the other part, while everyone is betting really high on India, all the economic frequency indicators are like, in a high speed already. People are actually believing in India's story. But at the same time, there is a funding winter. Not many fintechs are able to raise the funds, though they are in dire need. So, how do you read the current situation of the fintechs? Do you see there will be a consolidation? Do you see that large players will swallow the small players, or do you see, major restructuring consolidation is underway now?
And the answer lies in all three, Amol. You're a seasoned veteran in this. There will be some consolidation. We saw Kuvera sort of tie up with Cred. So we will see the larger financial majors sort of either acquire or partner with smaller ones. We will see some consolidation. We ourselves have sort of partnered with 10 offline players to come onto our platform. Now we're a consolidated business. And yeah, I think there would be some. I think the focus on profitability is fantastic, because I think it disciplines you to do the right thing for the customer, right? My permanent joke in this is that if you don't know how to make money for yourself, how will you make money for your customer, right? If you can't crack your economic puzzle, it's very difficult to crack the economic puzzle for your customer. So I think as long as businesses are focused on value creation for themselves and for their customers, importantly, we'll get the right answers. But yeah, I hope the VCs and the private equity guys start opening up their purse strings again for the right companies and the right business models, because India deserves more. India needs more.
Sure. Lastly, where do you see the fintech space maybe in next 2 3 years? Because why I'm also asking this is obviously we all are positive, optimistic. There are many changes, but perhaps the companies whom we are betting on really high are also going through regulatory hurdles. The companies who actually showcase a tremendous growth are going through a major challenge because of the funding winter. And surprisingly, which nobody expected, but regulators have also become very active after whatever the lending things, the BNPL, and kinds of issues happened there. On the other side, we partly discussed about influencers. The SEBI is also going very harsh on the influencers who are actually giving the wrong information, let's be very honest. So this will have some impact because ultimately it's an ecosystem. So how do you see, this maybe translating into ecosystem and where the fintechs will go maybe in next 2 to 3 years?
So, I mean, I'm a big fan of the regulator personally. I think the regulator has got such great intent and execution ability. And I think at least in our space, all the moves, while they look catastrophic at the point in time, but if you look back, they were all in the right direction with the customer at the center of it. So I think from a fintech overall, you said it, a combination of funding, combination of market circumstances, combination of regulator. We'll see consolidation. Running 5 compliance teams versus 1 compliance team is easier, right? So yeah, I think there will be a shakeout for the good of the customer. In every case, given age on my side and having 27, 28 years of experience, when you see some of the practices, you feel, what's happening here? And sooner rather than later, it tends to get corrected. So my sense is that while there is a lot of pain currently, it is the right kind of pain. It'll make people stronger. It'll make business models more robust. Like I was talking at a panel day before, and I said the same thing. I said, as long as you believe the regulator has your best interest in mind, you will do the right thing, right? Just because you are a fintech doesn't mean you don't follow time-tested regulations. Customer centricity, KYC, disclosures, transparencies are just good fiduciary responsibilities. So without sounding like a sales guy for Scriptbox, we've always had from day one, the amount of money we make, the commissions we make on our website, right? There is nothing to hide. This is how we make money. We don't ever offer a free account. We don't. It's not free. There is money attached to it.
Absolutely. Absolutely, as as you know, the famous philosopher said, nothing is free if it's valuable. So, so that's how it is. I think amazing talking to you. Very interesting points, Atul, that you put forward. So I wish you the best. आप पैसे बनाते रहो, millionaires लोगों को बनाते रहो, करोड़पति बनाते रहो. Thank you so much for sharing those fantastic thoughts here on the FinTech Diary and being part of ETBFSI special series. Thank you, Atul.
Thank you so much. It was an absolute pleasure. And thank you to your audience for listening in.
Thank you.